Question 1. Annuity suitability. Which of the following is a key factor that must be considered when determining the suitability of an annuity for a client under New Mexico's suitability guidelines? A. The client's credit score. B. The client's risk tolerance and financial goals. C. The availability of funds for investment in real estate. D. The length of time the client plans to keep the annuity for tax purposes. Answer: B. The client's risk tolerance and financial goals. Explanation: under New Mexico's suitability guidelines for annuities, the primary focus when recommending an annuity is the client's risk tolerance and financial goals. The purpose of suitability analysis is to ensure that the annuity is aligned with the client's financial profile, including factors such as income needs, investment objectives, and overall retirement planning. Factors like a client's credit score or their real estate investment plans are generally irrelevant to the suitability of an annuity purchase. Risk tolerance and financial goals ensure that the product is appropriate, especially when considering the client's age, income stability, and expected return. A failure to properly assess these factors could lead to regulatory violations and mis-selling. Question 2. Annuity taxation. Which of the following statements accurately reflects the taxation of a non-qualified annuity during the accumulation phase? A. Only the principal portion of any withdrawal is taxable. B. Earnings are tax-deferred, but withdrawals are taxed as ordinary income. C. The entire amount of any withdrawal is taxed immediately. D. Earnings are taxed as capital gains during the accumulation phase. Answer: B. Earnings are tax deferred, but withdrawals are taxed as ordinary income. Explanation: during the accumulation phase of a non-qualified annuity, earnings are tax deferred, meaning the investor does not pay taxes on the growth until funds are withdrawn. When a withdrawal is made, only the earnings, interest, dividends, capital gains are subject to tax as ordinary income. The principal portion of the withdrawal is not taxed because it was already paid with after-tax dollars. Therefore, the statement, earnings are tax deferred, but withdrawals are taxed as ordinary income, is correct. The other options are incorrect, as they either misstate how the principal is taxed or confuse the tax treatment of annuities with other investment products. Question 3. Scenario-based annuity product selection. Mr. Adams is 62 years old, planning to retire in 3 years, and he is concerned about running out of income during his retirement. He has a moderate risk tolerance and seeks a predictable stream of income throughout his retirement, but he also wants some flexibility in case of unexpected medical expenses. Based on these factors, which type of annuity would most likely meet Mr. Adams' needs? A. A fixed immediate annuity with a death benefit rider. B. A variable annuity with a long-term care rider. C. A deferred annuity with a cash refund feature. D. A fixed deferred annuity with inflation protection. Answer: D. A fixed deferred annuity with inflation protection. Explanation: given Mr. Adams' concerns about running out of income and his moderate risk tolerance, a fixed deferred annuity with inflation protection would be a suitable choice. This product guarantees a predictable income stream, a fixed annuity, while offering protection against inflation, which is critical for someone planning a long retirement and wanting to preserve purchasing power. The deferred nature of the annuity also allows the income to start once he retires at 65, meeting his retirement timeline. Options with an intermediate annuity with a death benefit rider would start paying immediately, which doesn't align with Mr. Adams' timeline, as he plans to retire in 3 years. Option B, variable annuity with a long-term care rider, introduces a higher degree of risk due to the variability in returns, which might not match his moderate risk tolerance. The long-term care rider adds value but is not his primary concern. Option C, deferred annuity with a cash refund feature, is not ideal because the cash refund feature is designed to pay the remaining balance to the beneficiary if the annuitant dies before receiving their premiums back, which doesn't address his concern of a reliable income stream for retirement. A fixed deferred annuity with inflation protection offers both the safety of predictable payments and the potential to combat inflation, making it the most suitable choice for Mr. Adams' situation. Question 4. Annuity payout options. Which of the following annuity payout options provides payments for the lifetime of the annuitant, but if the annuitant passes away early, the remaining principal is returned to the beneficiary? A. Life-only annuity. B. Joint life annuity. C. Installment refund annuity. D. Cash refund annuity. Answer: D. Cash refund annuity. Explanation: a cash refund annuity provides lifetime income to the annuitant, but if the annuitant passes away before receiving an amount equal to the original premium, the remaining amount is paid to the beneficiary as a lump sum. This ensures that the entire premium is either paid out to the annuitant during their lifetime or refunded to their beneficiary. The life-only annuity, option A, stops payments upon the death of the annuitant, and the joint life annuity, option B, continues until both annuitants have passed away. The installment refund annuity, option C, provides the remaining balance in installments, not as a lump sum. Question 5. Surrender charges. Which of the following statements best describes the purpose of surrender charges on annuities? A. Surrender charges are designed to penalize the annuitant for making withdrawals too early. B. Surrender charges are paid to the beneficiary upon the death of the annuitant. C. Surrender charges are designed to cover administrative costs for the insurer. D. Surrender charges are only applied to variable annuities, not fixed annuities. Answer A. Surrender charges are designed to penalize the annuitant for making withdrawals too early. Explanation. Surrender charges are imposed by annuity contracts if the annuitant withdraws funds during the early years of the contract. These charges are meant to discourage early withdrawals, which can disrupt the insurer's ability to manage the product's long-term financial structure. The charges help protect the insurer from losing money if the annuitant decides to cash out before a certain period, which is typically 5 to 10 years. The other options are incorrect because surrender charges are not paid to the beneficiary, they don't directly cover administrative costs, and they can apply to both fixed and variable annuities, depending on the terms of the contract. Question 6. Annuity taxation. Qualified versus non-qualified. Which of the following best describes the tax treatment of a non-qualified annuity during the payout phase? A. The entire withdrawal is tax-free. B. Only the earnings portion of the withdrawal is taxed as ordinary income. C. The entire withdrawal is taxed as capital gains. D. No taxes are due during the payout phase. Answer B. Only the earnings portion of the withdrawal is taxed as ordinary income. Explanation. For a non-qualified annuity, taxes are due on the earnings portion of any withdrawals during the payout phase. Since the annuity was funded with after-tax dollars, the principal, the amount originally invested, is not taxed again. However, any earnings, interest, dividends, etc. are subject to ordinary income tax rates. Option is incorrect because it misrepresents the taxability of annuities. Option C incorrectly refers to capital gains tax treatment, which is not applicable to annuities. Option D is incorrect because taxes must be paid on earnings. Question 7. Annuity contract features. Which of the following riders would most benefit an annuity holder concerned about the potential need for long-term care services later in life? A. Death benefit rider. B. Inflation protection rider. C. Long-term care rider. D. Guaranteed minimum withdrawal benefit rider. Answer C. Long-term care rider. Explanation. A long-term care rider allows the annuity holder to access funds from their annuity to cover long-term care costs, such as nursing home or in-home care expenses if they become necessary later in life. This rider is specifically designed to address the potential risk of needing long-term care. The death benefit rider, option A, provides a benefit to the beneficiary in the event of the annuitant's death, but does not address long-term care needs. The inflation protection rider, option B, helps to keep annuity payments in line with inflation but does not specifically cater to long-term care needs. The guaranteed minimum withdrawal benefit rider, option D, provides a guaranteed withdrawal amount which does not directly relate to long-term care services. Question 8. Annuity suitability. Age and retirement goals. MS. Johnson is 56 years old and plans to retire at age 65. She is concerned about outliving her savings and wants a guaranteed income stream throughout her retirement. What type of annuity would likely be most suitable for MS? Johnson's needs. A. Immediate fixed annuity. B. Deferred fixed annuity. C. Variable annuity. D. Single premium immediate annuity. Answer B. Deferred fixed annuity. Explanation. A deferred fixed annuity would likely be the best option for MS Johnson, as it would allow her to begin receiving guaranteed income at age 65, providing a stable income stream for her retirement. Since she plans to retire at age 65, the annuity would begin paying out once she reaches the age, and the fixed nature of the annuity would guarantee a predictable income stream. An immediate fixed annuity, option A, would start paying out immediately, which is not suitable because she is not yet retired. A variable annuity, option C, carries investment risk which may not align with her need for guaranteed income. A single premium immediate annuity, option D, is also an immediate payment option which doesn't match her timeline. Question 9. Annuity and estate planning. Which of the following is the primary benefit of using an annuity as part of estate planning? A. It provides tax-free growth during the accumulation phase. B. It allows for the designation of beneficiaries to avoid probate. C. It guarantees a return on investment regardless of market conditions. D. It offers a higher rate of return than other investment products. Answer: B. It allows for the designation of beneficiaries to avoid probate. Explanation: the primary benefit of using an annuity in estate planning is its ability to designate beneficiaries, allowing the proceeds to bypass the probate process upon the annuitant's death. This ensures that the annuity benefits are passed on directly to the designated beneficiary without the need for lengthy court proceedings. While annuities do offer tax-deferred growth, Option A, the major advantage in estate planning is avoiding probate. The claim that annuities guarantee returns or provide higher rates of return, options C and D, is incorrect. Annuities offer predictable income, but not necessarily higher returns than other investment products. Question 10. Annuity riders. Which of the following riders allows an annuity holder to increase their future income payments based on an increase in the cost of living? A. Long-term care rider. B. Inflation protection rider. C. Death benefit rider. D. Guaranteed minimum income rider. Correct answer: B. Inflation protection rider. Explanation: the inflation protection rider adjusts the income payments from the annuity to keep pace with inflation. This ensures that the annuitant's income retains its purchasing power over time, which is important for individuals who are concerned about rising costs in retirement. The long-term care rider, option A, allows access to annuity funds for long-term care needs but does not address inflation. The death benefit rider, option C, is focused on providing a death benefit to the beneficiary and does not affect income payments. The guaranteed minimum income rider, option D, ensures a baseline income but does not adjust for inflation. Question 11. Annuity types and payout structures. Which of the following is a characteristic of a variable annuity? A. Payments are guaranteed to remain the same regardless of market performance. B. The annuitant assumes the investment risk. C. The insurance company bears the investment risk. D. Payouts are made only in the form of a lump sum. Answer: B. The annuitant assumes the investment risk. Explanation: in a variable annuity, the annuitant assumes the investment risk because the value of the annuity fluctuates based on the performance of the underlying investments. The insurance company does not guarantee the investment return. Option is incorrect because in a variable annuity, payouts depend on market performance. Option C is incorrect as the insurance company typically guarantees a minimum payout, but the investment risk is borne by the annuitant. Option D is incorrect because variable annuities typically offer periodic payments, not just lump sums. Question 12. Annuity taxation. Qualified versus non-qualified. Which of the following best describes the tax treatment of a qualified annuity during the accumulation phase? A. Earnings are taxed at ordinary income rates. B. Earnings grow tax-deferred and the principal is taxed upon withdrawal. C. Earnings are tax-free. D. Contributions are tax-free, but earnings are taxable. Answer: B. Earnings grow tax-deferred and the principal is taxed upon withdrawal. Explanation: in a qualified annuity, the contributions are typically made with pre-tax dollars and the earnings grow tax-deferred until withdrawn. Upon withdrawal, the entire amount, both principal and earnings, is taxed as ordinary income. Option A is incorrect because earnings are not taxed during the accumulation phase. Option C is incorrect because earnings are taxable upon withdrawal. Option D is partially correct, but it does not fully explain the tax treatment of qualified annuities. Question 13. Annuity types. Which of the following types of annuities provides income for the lifetime of the annuitant with no option for payments to a beneficiary after death? A. Joint life annuity. B. Life-only annuity. C. Fixed period annuity. D. Refund annuity. Answer: B. Life-only annuity. Explanation: a life-only annuity provides guaranteed income for the lifetime of the annuitant, but once the annuitant dies, the payments cease and no death benefit is paid to the beneficiary. Option: it provides payments to two annuitants, which is different. Option C specifies income for a set period, regardless of whether the annuitant lives or dies. Option D offers a refund to the beneficiary if the annuitant dies before the full premium is paid out. Question 14. Annuity riders. Which of the following riders provides a minimum income that the annuitant is guaranteed to receive, even if the annuity's underlying investments perform poorly? A. Guaranteed minimum withdrawal benefit rider. B. Inflation protection rider. C. Guaranteed minimum income benefit rider. D. Death benefit rider. Answer: C. Guaranteed minimum income benefit rider. Explanation: The Guaranteed Minimum Income Benefit rider guarantees that the annuitant will receive a minimum level of income regardless of the performance of the underlying investments. Option was a Guaranteed Minimum Withdrawal Benefit rider guarantees a minimum withdrawal amount but does not guarantee income. Option B is designed to protect against inflation but does not guarantee a minimum income. Option D provides a death benefit but does not affect the annuitant's income. Question 15. Annuity suitability. Mr. Roberts is looking for a retirement plan that will provide a stable income stream regardless of his financial market exposure. Which type of annuity would be most appropriate for him? A. Variable annuity. B. Fixed annuity. C. Indexed annuity. D. Equity indexed annuity. Answer: B. Fixed annuity. Explanation: a fixed annuity provides a stable, guaranteed income stream for the annuitant regardless of market conditions. This makes it the most appropriate choice for someone like Mr. Roberts, who is seeking a stable income. Option or variable annuity exposes the annuitant to market risk, while options C and D, indexed and equity indexed annuities, are linked to market indices and can result in variable returns. Question 16. Annuity beneficiaries. What is the primary benefit of naming a beneficiary on an annuity contract? A. It guarantees the annuitant's income will increase every year. B. It ensures the annuitant's assets will be divided equally among heirs. C. It allows the annuity's death benefit to avoid probate. D. It enables the annuity holder to skip paying taxes on the annuity earnings. Answer: C. It allows the annuity's death benefit to avoid probate. Explanation: by naming a beneficiary, the annuity proceeds will pass directly to the beneficiary upon the annuitant's death, avoiding probate. This is one of the main benefits of annuity contracts in estate planning. Option is incorrect because income is typically fixed and not guaranteed to increase every year. Option B is not a primary function of a beneficiary designation. Option D is incorrect because taxes are still due on earnings when withdrawn. Question 17. Annuity and income planning. Which of the following annuity types provides the annuitant with payments that increase over time to keep up with inflation? A. Fixed annuity. B. Variable annuity. C. Inflation protected annuity. D. Life-only annuity. Answer: C. Inflation protected annuity. Explanation: an inflation protected annuity includes an inflation rider, which increases payments over time to keep up with inflation. This ensures the annuitant's income maintains purchasing power. Option was fixed annuity provides a set income amount that does not change. Option B, variable annuity, can fluctuate based on market performance but does not guarantee inflation protection. Option D, life-only annuity, does not increase payments to account for inflation. Question 18. Annuity contracts and taxes. Which of the following is true regarding the tax treatment of a non-qualified annuity when funds are withdrawn? A. Withdrawals are tax-free. B. Only the principal is taxed as ordinary income. C. The entire withdrawal amount is taxed as ordinary income with a portion attributed to principal. D. Only the earnings portion is taxed as ordinary income. Answer: D. Only the earnings portion is taxed as ordinary income. Explanation: in a non-qualified annuity, only the earnings portion of a withdrawal is taxed as ordinary income. The principal, the amount originally invested, is not taxed again. This tax treatment is based on the first in, first out FIFO rule, meaning earnings are withdrawn first. Option A is incorrect because withdrawals are not tax-free. Option B incorrectly suggests that only the principal is taxed. Option C is also incorrect because the principal is not taxed, only the earnings are. Question 19. Annuity contracts and beneficiary designations. Which of the following best describes the tax treatment of the beneficiary's inheritance of an annuity death benefit? A. The death benefit is tax-free to the beneficiary. B. The beneficiary is taxed on the death benefit based on the annuitant's original tax bracket. C. The beneficiary is taxed on the death benefit as ordinary income. D. The death benefit is taxed at capital gains rates. Answer: C. The beneficiary is taxed on the death benefit as ordinary income. Explanation: when a beneficiary inherits an annuity, the death benefit is generally taxed as ordinary income. The tax treatment depends on the earnings portion of the annuity, not the annuitant's original tax bracket. Option A is incorrect because the death benefit is typically taxable. Option B is not correct because the annuitant's tax bracket does not apply to the beneficiary. Option D is incorrect as death benefits are taxed as ordinary income, not capital gains. Question 20. Annuity payout options. Which of the following annuity payout options provides payments for a specified period, such as 20 years, but stops paying if the annuitant dies before the period ends? A. Period certain annuity. B. Life with period certain annuity. C. Fixed annuity. D. Joint life annuity. Answer: A period certain annuity. Explanation: a period certain annuity provides income for a specific period, such as 20 years, but the payments stop if the annuitant dies before the period ends. Option B, life with period certain annuity, guarantees payments for the annuitant's lifetime and a specified period, ensuring that payments will continue for at least the period certain. Option C is too general, and option D provides payments until both annuitants have died, which differs from a period certain annuity. Question 21. Annuity types and features. Which of the following annuity options provides income payments for the life of the annuitant, with payments continuing to a named beneficiary for a specified period if the annuitant dies early? A. Life annuity. B. Life with period certain annuity. C. Joint and survivor annuity. D. Fixed period annuity. Answer: B. Life with period certain annuity. Explanation: a life with period certain annuity provides guaranteed income for the annuitant's life, with payments continuing to a beneficiary if the annuitant dies before the specified period ends. Option A only provides payments during the annuitant's lifetime, with no beneficiary benefit after death. Option C provides income for the lives of two people, but does not include a specified period. Option D provides payments for a set period, not linked to the annuitant's life. Question 22. Annuity taxation. Withdrawal phase. If an annuitant withdraws funds from a non-qualified annuity, how is the tax treatment determined? A. The entire withdrawal is tax-free. B. Only the earnings are taxed and the principal is not taxed. C. The entire withdrawal is taxed as ordinary income. D. Only the principal is taxed as ordinary income. Answer: B. Only the earnings are taxed and the principal is not taxed. Explanation: in a non-qualified annuity, the principal is not taxed upon withdrawal. Only the earnings portion of the withdrawal is subject to tax as ordinary income. Option A is incorrect because the principal portion is not taxed. Option C is incorrect because only earnings are taxed, not the entire withdrawal. Option D is incorrect as the principal portion is not taxed. Question 23. Annuity payout options. Which of the following annuity payout options would result in payments that continue until both the annuitant and their spouse die? A. Life with period certain annuity. B. Life only annuity. C. Joint and survivor annuity. D. Fixed period annuity. Answer: C. Joint and survivor annuity. Explanation: a joint and survivor annuity provides income payments to the annuitant and their spouse for both of their lifetimes. Payments continue after the first annuitant's death, often at a reduced level, until both individuals have passed. Option A provides payments for a specified period, but not to both the annuitant and their spouse. Option B provides payments for only the annuitant's lifetime, with no survivor benefit. Option D provides payments for a specified time, not linked to the lives of the annuitant and their spouse. Question 24. Annuity contract provisions. Which of the following is a provision that allows an annuity owner to increase their future income payments by investing more funds into the annuity? A. Premium payment rider. B. Accumulation phase. C. Additional purchase payment rider. D. Immediate annuity. Answer: C. Additional purchase payment rider. Explanation: the additional purchase payment rider allows an annuity holder to make additional investments into their annuity, which can increase future income payments. Option A, a premium payment rider, typically refers to provisions that relate to the amount and frequency of premium payments. Option B refers to the phase where funds accumulate before payouts begin. Option D refers to an annuity that starts payouts immediately upon purchase. Question 25. Annuity surrender charges. Which of the following best describes the impact of surrender charges on an annuity? A. They reduce the death benefit payout. B. They apply if the annuitant withdraws funds during the accumulation phase. C. They are only assessed during the income phase. D. They reduce the annuitant's premium payments. Answer: B. They apply if the annuitant withdraws funds during the accumulation phase. Explanation: surrender charges are fees that apply if the annuitant withdraws funds during the accumulation phase before a specified period has passed. These charges are typically highest in the early years of the annuity. Option A is incorrect because surrender charges do not affect the death benefit. Option C is incorrect because surrender charges apply only during the accumulation phase, not the income phase. Option D is incorrect because surrender charges do not affect premium payments. Question 26. Annuity guarantees. Which of the following is a common guarantee offered by insurance companies in fixed annuities? A. Guaranteed minimum income. B. Guaranteed investment returns. C. Guaranteed payout of principal and earnings. D. Guaranteed death benefit regardless of market conditions. Answer: C. Guaranteed payout of principal and earnings. Explanation: in a fixed annuity, the insurance company guarantees both the principal and the earnings. This means the annuitant will receive fixed payments based on a guaranteed rate of return. Option A is incorrect because while the income is guaranteed, it does not specify both principal and earnings. Option B refers to variable annuities where the returns are not guaranteed. Option D refers to death benefits, not income guarantees. Question 27. Annuity riders. Which of the following is an example of an annuity rider that guarantees an annuitant a minimum level of income regardless of investment performance? A. Guaranteed minimum income benefit GMIB rider. B. Accumulation benefit rider. C. Death benefit rider. D. Cost of living rider. Answer: A. Guaranteed minimum income benefit GMIB rider. Explanation: a guaranteed minimum income benefit GMIB rider ensures that the annuitant will receive a minimum income regardless of the performance of the annuity's investments. This rider helps protect the annuitant from market downturns. Option B is incorrect because the accumulation benefit rider relates to growing the annuity's value, not guaranteeing income. Option C provides the death benefit but does not affect income. Option D adjusts the income based on inflation but is not a minimum income guarantee. Question 28. Annuity income taxes. Which of the following describes the tax treatment of qualified annuity payments to the annuitant? A. They are partially tax deferred. B. They are taxed as ordinary income upon withdrawal. C. They are tax-free with only earnings taxed. D. They are taxed at capital gains rates. Answer: B. They are taxed as ordinary income upon withdrawal. Explanation: in a qualified annuity, the annuitant's entire withdrawal, including both principal and earnings, is taxed as ordinary income because contributions were made on a pre-tax basis. Option A is incorrect because the entire withdrawal is taxed. Option C is incorrect because qualified annuities do not have tax-free withdrawals. Option D is incorrect as annuity withdrawals are taxed as ordinary income, not capital gains. Question 29. Annuity taxation. Death benefit. Which of the following is the tax treatment of the death benefit from a non-qualified annuity? A. The death benefit is tax-free. B. The beneficiary pays taxes only on the principal amount. C. The beneficiary pays taxes only on the earnings portion. D. The entire death benefit is taxed as capital gains. Answer: C. The beneficiary pays taxes only on the earnings portion. Explanation: in a non-qualified annuity, the beneficiary is taxed on the earnings portion of the death benefit as ordinary income, while the principal is not taxed. Option A is incorrect because the death benefit is taxable. Option B is incorrect because the principal is not taxable, but the earnings are. Option D is incorrect because the death benefit is taxed as ordinary income, not capital gains. Question 30. Annuity contracts and withdrawals. Which of the following is typically true about early withdrawals from an annuity before the age of 59? 1. 2A. There are no penalties for early withdrawals. B. Withdrawals are subject to income tax and a 10% federal tax penalty. C. Withdrawals are taxed at a reduced rate. D. Early withdrawals are treated as loans, not taxable. Answer: B. Withdrawals are subject to income tax and a 10% federal tax penalty. Explanation: if an annuity owner withdraws funds before the age of 59, 1. 2. The withdrawn amount is subject to income tax and an additional 10% federal tax penalty on the earnings. Option A is incorrect because early withdrawals typically incur penalties. Option C is incorrect because early withdrawals are subject to standard income tax rates, not reduced rates. Option D is incorrect because withdrawals are not treated as loans. They are subject to taxes and penalties.